Ever feel nervous about putting your money into investments when the economy takes a nosedive? It's pretty common to worry about losing money when times are tough. It's easy to get anxious and second guess your choices when the market's shaky, but while everyone is playing it safe, you might actually be missing out on a chance to benefit from the situation. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. Recessions could actually be a golden opportunity for certain types of investments. Dividend stocks, which pay you regular income, can be a smart choice when the economy is down. In this quick video overview, we'll cover why these stocks are worth considering during tough times, and how they might help you earn money even when the economy isn't doing so well. First though, let's talk about recessions. Understanding recessions. Alright, let's break down what a recession is in simple terms. Think of a recession as a rough period for the economy, like when things just aren't running as smoothly as they usually do. To officially call it a recession, a country's economy has to shrink, meaning the total value of everything produced, called gross domestic product or GDP, needs to drop for at least 2 quarters in a row, or 6 months. Basically, the economy is shrinking for half a year. So what happens during a recession? First, there's an economic slowdown. Businesses start to struggle because people aren't spending as much money. Imagine you ran a shop and suddenly hardly anyone came to buy anything. And that's what it's like for companies during a recession. With less money being spent, the overall growth of the economy slows down because there's less money moving around. Next, we see rising unemployment. Since people aren't buying as much, businesses might need to cut costs to stay afloat. One way they do this is by laying off workers or not hiring new ones. So during a recession, you might notice that more people are losing their jobs or having a hard time finding new ones. It's a tough time for everyone looking for work. And finally, consumer spending tends to decline. When people are worried about their jobs or their finances, they start to spend less money. Think about it, if you're unsure about your future, you'd probably save more and buy fewer things too. When a lot of people do this, it makes the slowdown even worse because less spending means the economy struggles even more. It can be a vicious cycle of decline unless something changes. When do dividends work best? Now that we've already explained what a recession is, let's move on to what will be the appeal of dividends during these hard times. So while the economy is in a downturn where everything struggles, like the market's in a slump, everyone's feeling a bit uneasy. And that's when dividend paying stocks really start to stand out as investments. To further explain this, let's look at the Great Recession of 2008. This recession took place in 2008 and recovered by mid-2009. A good example of dividend stock that did well during a recession is Realty Income. Why? Realty Income shines during recessions due to its focus on essential services like drugstores and dollar stores, which keep generating steady rental income. The company pays monthly dividends, providing a reliable income stream. Its long-term leases and diversified tenant base further stabilize revenue, while its history of maintaining or increasing dividends makes it a dependable choice for investors seeking stability in tough economic times. Now, in 2008, Realty Income didn't even cut their dividends, they even increased it during that time. If you had invested in Realty Income during that time, you wouldn't just have earned dividends, the value of your initial investment would have also increased by approximately 270% from 2008 to 2024 due to the growth of the stock. If we look at the company now, it pays the monthly dividend and the growth of the company isn't jeopardized by it. Here's an example of a user on Trading212 who earned a dividend in Realty Income. And here's the growth of Realty Income since the same user decided to invest in it. Platforms like Trading212 offer a user-friendly way to invest in companies that provide steady dividend income, helping you navigate both good and challenging economic times. I asked Trading212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, then here it is. DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thanks for your support and thanks to Trading212 for sponsoring this video. Dividends can be a solid investment option during a recession, and they're like having a dependable side income that continues to come in even when your main source of income is unstable. This consistent cash flow can be very useful when other parts of your portfolio are experiencing volatility. Dividend stocks tend to provide higher yields than bonds or savings accounts, which means you have some financial flexibility, not just stability. This makes them appealing during economic downturns. Regular payouts from dividend stocks can help you keep your financial goals on track and manage economic challenges more effectively. When the market falls, these stocks may also decrease in price, but this drop can be seen as a buying opportunity rather than a negative outcome. To understand why dividend stocks are effective in recessions, let's look at historical data from a company during previous economic downturns. Procter & Gamble, P&G. So let's go back to the 2008 financial crisis again. It was a tough time for a lot of companies, but Procter & Gamble really stood out. Even when everything was going sideways, they not only kept paying their dividends, but actually increased them. It's pretty impressive, right? P&G has this incredible history of paying dividends, over 130 years non-stop. And during the chaos of 2008, when most companies were cutting back, P&G raised their dividend by 14%. That marked the 52nd consecutive year they did that, which is why they're in this elite group called Dividend Kings. The reason they could do this is because they sell stuff that people always need, like cleaning supplies and personal care products. Even when people were cutting back on other things, they still had to buy these essentials. And thanks to that steady demand, P&G's revenue went up by 9% in 2008, hitting about $83.5 billion, and their net income jumped by 17% to $12.1 billion. For P&G, their strong dividend policy wasn't just about keeping shareholders happy, it showed how solid their business was. They were able to keep things steady because they were selling products that everyone still needed, no matter how bad the economy got. If you reinvest those dividends, you can snag more shares at a lower price. So to sum it all up, during a recession, dividend stocks are often backed by companies with strong financials. They give you a steady income when you need it most, and they offer a smart way to potentially increase your gains when the market bounces back. For anyone looking to navigate a recession, dividend stocks are definitely worth considering. Why recessions create opportunities for dividend investors. As we explained earlier, recessions can be either a good or bad thing depending on how you'll act and how you'll counter it. It creates opportunities for most investors when they decide to invest in stocks with strong financials that pay dividends and have a solid chance of bouncing back. Think of it like hitting two birds with one stone. You're not just buying stocks at lower prices, which can lead to significant gains when the market recovers, but you're also earning dividends along the way. Dividends are like a reward for holding on to those stocks through the rough patches, providing you with regular income even when the overall market is down. During a recession, high-quality companies with a history of reliable dividend payments often still see their stock prices drop, but their ability to pay dividends remains strong. These companies are typically more resilient and have the financial stability to weather economic storms. For investors who do their homework and select these resilient stocks, it's an opportunity to buy at discounted prices, while still enjoying the benefits of regular dividend income. Moreover, buying stocks during a recession can also help you build a diversified portfolio, with investments in companies that are poised to recover and grow once the economy improves. Potential risks. There's more to this story, and it's important to be aware of potential downsides too. First off, not all dividends are as safe as they might seem. Just because a company has been paying dividends consistently doesn't mean they'll keep doing so forever. If they're facing financial trouble, they might reduce or suspend those payments altogether. So while dividends can be a nice source of income, they're not a sure thing. That's why it's crucial to pick up companies that have a solid history and are financially stable. And then there's this economic side of things. Even companies that are usually in great shape can take a hit during a deep or long-lasting recession. So it's a good idea to keep an eye on the financial health of companies you're invested in. Regularly checking earnings, balance sheets, and staying tuned to the broader economic picture can help you make sure they're still in a good position to keep paying dividends. In short, while dividend stocks have their perks, like steady income and potential growth, they're not without risks. Not all dividends are guaranteed, and even strong companies can struggle during tough economic times. So all in all, dividend stocks can be pretty solid, especially when the economy takes a hit. They can be a reliable source of income if you picked companies with strong financials, but here's the thing, it's not something you can just set and forget. Even the best companies can stumble during a recession, so you've got to stay on top of it. Dividend stocks can definitely work in a recession, but you've got to stay engaged. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!